In this video, we'll be taking a look at the top 5 stocks in my dividend portfolio by market value. And as I cover each stock, I'll provide a little detail on why I like the stock in particular and some potential issues I might see as well. And then I'll also be talking about the general price range that I am looking to buy the stocks at. So starting off, the 5th largest position in the portfolio is Air Products and Chemicals, ticker symbol APD. And APD produces, processes, and sells a wide variety of gases for various industrial applications and processes throughout the world. The core gas business provides APD about 92% of their revenues, and then the remaining 8% of revenues comes from the sale of industrial gases equipment. The main reason that I like APD is that they have pretty consistent revenues and net income growth over time, and they have consistently raised their dividend at a fairly decent rate for a very long time. The part I think that is a bit less than ideal for APD is they have struggled a bit recently with inconsistent and rather weak cash flow over the last few years. So I would definitely like to see that improve in the coming years. Looking at some specific metrics, right now, APD has a dividend yield of 2.4% with a payout ratio of 62%, and their 5-year average dividend growth rate is 11%, and they have 42 years of consecutive dividend increases. Right now, I own 0.96 shares of APD, which are valued at $280, and that represents about 6.4% of my portfolio. My average cost on these shares is $258, and if I were to buy more APD, I think I would generally want to be buying around the $250 level or below at this point in time. I like the stock, but it's certainly not my favorite company, so that's why I'm trying to be a bit more conservative with the valuation on this one. This next company is the 4th largest position in my dividend portfolio, and that is Apple, ticker symbol AAPL. Apple, as most of you probably know, designs and sells electronics products, with 52% of their revenue coming from the iPhone alone. Mac, iPad, and wearables sales each contribute about 10% of revenues as well, and then the remaining 20%-ish of revenues comes from the service business. There are a lot of things that I like about Apple, but one of the biggest factors in their success, I think, is their really strong brand loyalty that keeps bringing customers back over time for more and more of their products. And another very strong point about Apple that I like is their balance sheet. Although they do have about $110 billion in debt, which seems like a whole lot, they have as well $135 billion in current assets, and their net income in 2022 was $100 billion, which means they could pay off that debt very quickly if they needed to. One of the potential issues I can see Apple having is the fact that they're so reliant on the iPhone, having that product make up over 50% of their revenues. This means if they stop innovating or fall behind potentially, their sales could drop dramatically, which is really a risk that all tech companies face. Currently, Apple's dividend yield is at a very low 0.55%, but their payout ratio is also very low at 15.5%. Over the past 5 years, their average dividend growth rate has been about 8%, which is definitely lower than I would like to see from Apple, but they've also been buying back lots of shares, which is another way to return value to shareholders if it's done right. And they have been growing the dividend for 11 consecutive years, which is a good start to what will hopefully become a long streak. Currently, I own 2.08 shares of Apple, which are valued at $346, and this represents 7.9% of my dividend portfolio. My average cost on these shares is $132, and around that price, around the $130 price range, is really where I want to be buying the stock at. Moving on now to the 3rd largest position in my dividend portfolio, and that is the other tech giant in Microsoft, ticker symbol MSFT. Microsoft is a software and hardware company with 32% of their revenue coming from their productivity and business processes segment, which includes most of their software such as the Office products, LinkedIn, and various ERP and CRM solutions. The intelligent cloud segment brings in 41% of their revenues, and the personal computing segment, which includes Microsoft computers as well as Windows licensing and other hardware and software products such as the Xbox and Microsoft Edge, brings in the remaining 27% of revenues. I think one of Microsoft's biggest advantages is in their diversification of revenues to some degree. They are mainly a software company, but they do have a lot of physical products as well, and they are consistently innovating in order to grow both their revenue and net income pretty quickly. In terms of issues for Microsoft, there's certainly a lot of fierce competition in their cloud business, but I think that business and that market as a whole is going to continue to grow for a long time into the future, so I don't really think that will be too much of an issue for them. Right now, Microsoft has a dividend yield of 0.9% and a payout ratio of 29%. I'm quite happy as well with their 5-year average dividend growth rate of 9.9%, and they have been growing the dividend for 18 consecutive years, which is as long as they have been paying a dividend. Currently, I own 1.28 shares of Microsoft, which are valued at $367, and that represents 8.4% of my portfolio. My average cost on these shares is $228, and I definitely want Microsoft to be below $250 per share before I think about buying more. And ideally, I'd really want it in the 220s or 230s, but I don't want to be super picky with this one because I do believe it's a fantastic business. The second largest position in my dividend portfolio is none other than the big bank, JPMorgan, ticker symbol JPM. JPMorgan is a very large and complex financial institution, but they split their business into 4 basic segments, which are consumer and community banking, corporate and investment banking, commercial banking, and then asset and wealth management. One of the aspects that I really like about JPMorgan is their management. I have a whole lot of confidence in Jamie Dimon and also his ability to get the right people into the other senior management roles, which gives me lots of confidence in those other senior management as well. JP Morgan also has a very consistent record of revenue and income growth, as well as a great share buyback policy. Currently, their yield is about 2.8% with a payout ratio of 30%, which is very low considering their yield. Their current 5-year dividend growth rate average is 12.9%, which is pretty nice to see, but I certainly expect to see that fall a little bit in the next few years because they actually didn't raise the dividend at all in 2022, even though they still paid more in dividends in 2022 than they did in 2021. And they currently have 12 consecutive years of increasing dividends. Right now, I own 2.62 shares of JP Morgan, which are valued at $370, and that represents 8.5% of my portfolio. My average cost on these shares is $122, and that's the general range I would be buying more at, I think. The stock was close to $100 per share in July and September, and I definitely wish I bought more at that time, but there were other opportunities in that time range that I was taking advantage of as well. And now for the last company on the list, the largest position in my dividend portfolio, which is none other than Johnson & Johnson, ticker symbol J&J. J&J operates in 3 business segments, which are consumer health, pharmaceutical, and medtech. The pharmaceutical segment makes up about 55% of their business, with the medtech segment making up 29% of the business, and the consumer health segment making up 16%. Notably, the consumer health segment will be spinning out of J&J into a separate publicly traded company called Kenvue, and that's supposed to happen sometime by the end of 2023. One of the biggest things that I like about Johnson & Johnson is just their strength and consistency over time and track record of growing their income and revenues. Being a pharmaceutical company is certainly not easy. You have to be consistently innovating and producing new, useful, and safe drugs, but J&J has a long track record of doing just that, and they've also created some higher growth segments, I guess, like their medtech segment. Currently, J&J has a dividend yield of 2.9% with a payout ratio of 44% and a 5-year average dividend growth rate of 6.1%. Just recently, they also announced a 5.3% dividend hike from $4.52 to $4.76 annually per share, and J&J has increased their dividend for 61 consecutive years, granting them the status of Dividend King. As of now, I own 2.53 shares of Johnson & Johnson, which has a market value of $410, and that makes up 9.4% of my portfolio. My average cost on the shares is $161, which is pretty much where the stock is trading at right now, and for me, in the $160 range is a pretty solid price for J&J, and I was really loading up on J&J in January and February when the stock price was in the low 160s and 150s. One thing I noticed about these positions as I was making this video is that the highest dividend yield among these 5 companies is 2.9%, with 2 of them having yields below 1%. Although these exact numbers aren't intentional, the general idea is. My focus right now for this portfolio is on high quality companies, and they don't necessarily have to pay large dividends, but I want them to be companies that have shown they can increase their dividend at a fast pace and grow their business at a fast pace, and also that I believe they will continue increasing the dividend at a fast pace for many years in the future. In aggregate, these 5 companies have a market value of $1,774 in my portfolio, which represents 40.7% of the portfolio, and they have a weighted average dividend yield of just 1.95% and a weighted average 5-year dividend growth rate of 9.4%. These are really all metrics that I'm extremely pleased with, and I hope that over time, the 5-year dividend growth rate of my entire portfolio will be closer to that of these 5 companies. If you have any thoughts to share on any of these companies, definitely let me know down in the comments below. Make sure to subscribe to the channel if you haven't already, and thanks for watching. I will see you all in the next one.